The line between tax planning and financial planning is becoming increasingly blurry. Here's what I mean by that. We have traditionally categorized tax planning as a discipline within financial planning. Some advisors embrace it, while others consider it out of scope. And while some advisors avoid it because they don't ever want to be put in a position where a client may consider their planning exercise to be construed as tax advice, I'm not talking about capital TA tax advice. We're talking about tax planning. And here's the problem with both the broad categorization and the outright avoidance. Where does one thing end and the next begin? Look, I can see the extremes easily enough. At one extreme, if we're talking about budgeting and life insurance, we're in a generic quantitative realm that barely necessitates any special tools. The only real special sauce here is an aesthetically pleasing layout. In other words, as long as the output is pretty, we're on point. On the other extreme, if we're talking about last year's taxes and the mechanics of filing a return, we're in a highly regimented realm that requires precise calculations, and the aesthetics and the layout just don't matter. The special sauce here is precision and credibility. But that's not where our minds are when we hear the terms financial planning and tax planning. Rather, we hear financial planning and we think of forecasts, probably stretching from a few years to 40 or 50 years into the future. We think about long term decisioning and how the financial choices we make today will affect us some number of years into the future. And when we hear tax planning, we mostly think of next year's taxes. What should we be doing now to ensure an optimal tax situation by the end of this year, so that when we file in the first quarter of the following year, we've done all we can to take advantage of the tax provisions? So here's my point. After the basic number crunching is done to determine how much we need to save to get where we want to be, we have to decide what kind of vehicle to use to accumulate those dollars. And what primarily drives that decision? Taxes. When we're evaluating how to draw down assets, and as part of a projection or for the immediate future, what primarily drives that decision? Taxes. When we've accumulated a substantial sum of tax deferred assets and we're trying to decide whether to convert those funds to a Roth, what, what primarily drives that decision? Yeah, taxes. And when we're looking at whether to bunch deductions, to take a standard deduction every other year, it's taxes that drive these decisions. So I'll say it again, the line between tax planning and financial planning is becoming increasingly blurry. And to complicate it, neither activity can be done well without the other. A tax planning software without a robust projection engine is short sighted, and a financial planning software without a robust tax engine is just a basic number cruncher. Because if I want to measure the impact of a Roth conversion on my taxes, I have to look at both sides, the conversion and the distributions. And because if I want to model a deduction bunching strategy, I have to be able to look at more than just one year. And if I want to determine whether to save in a tax deferred or a tax free investment, the savings years and the accumulation forecast only tell half the story, because without tax aware distribution planning, I'm left with an average tax rate that misses the whole point of a tax optimized portfolio. So help me out here. Am I missing something? Am I oversimplifying the distinction? Look, I understand that precision degrades the further we look into the future. But why would we use that as an excuse to abandon the one thing we can probably be most certain about, which is taxes? I will be taxed every year between now and life expectancy, and the odds of that changing are slim to none. So why would I treat this year any differently than any future year? Taxes will be paid in all of those years, and the way in which taxes will be assessed is unlikely to change dramatically. Furthermore, using the current tax model as a way of forecasting actual taxes in the future is a far better means of approximating the actual tax burden than an average tax rate ever will be. So I guess that's my point. If I can evaluate this year's taxes, and if I can prepare for next year's taxes, and the year after that, and the year after that, then why wouldn't I do my tax planning and preparation in conjunction with the software that is also capable of projecting the rest of my finances so that my tax planning and my financial planning are in mutual harmony with each other? Yeah, that's a thing. You don't have to choose. You can have both. Stay with me. More to come. Thanks for being here.